Recording. So, good morning, everyone. I am Ruth Hackney. I'm the CEO here at Raskow, and I am excited to be hosting Douglas Berry today. The Commercial Services Committee wanted him to come and talk to us about tenant improvement depreciation. I know, an exciting topic for 8 a.m. on a Wednesday. But we're really happy to have him here. I just wanted to go over a little bit of housekeeping. Because of the format of this webinar, you are all on mute. And we can't see your videos unless you raise your hand. Which we'll wait until the end if anybody has questions where they want to raise their hand. And then we can let you onto the screen. Otherwise, if you have any questions as Douglas is talking, feel free to put that in the Q&A or in the chat. I am monitoring both of those, and I will share those questions with Douglas as they come up. So. Without further ado, I would like to introduce Douglas Berry with SVA Certified Public Accountants. He is not only representing Raskow, but I know he represents many of you, and he has a lot of really great information on this particular subject. So, Douglas, I will let you take it from here.
Great. So I'm pulling up my slide deck now. If you can just confirm, Ruth, when that is up and running.
It is up and running.
Perfect. So again, I want to thank Ruth and everybody at Realtors Association of South Central for inviting me to speak this morning. The topic today is tenant improvement depreciation. So you'll hear that less and more. We'll talk about what we call qualified improvement property. Ruth gave you kind of a little bit of my background and introduction, so I can skip some of that. But for those of you who have seen me in multiple places, not only do I work with the association, but I also work upstairs with the Wisconsin Realtors Association. So I do quite a bit with realtors throughout the state. So it wouldn't be a presentation from an attorney or an accountant or somebody like that if we didn't start with a disclaimer, right? So I just want to make sure that I'm clear that I'm going to provide you with some general tax information today, and it really isn't a substitute for you talking to your tax advisor about your specific situation. And I bring that up because there are so many pitfalls and foot faults that can happen when we talk about taxes that every situation is unique. So what I always like to say is your mileage may vary. So with that, today what I want to cover is what is qualified improvement property, and we'll talk a little bit about the history of that. We'll talk about the retail glitch. Maybe some of you are here because you're going, I know that there was this issue that the Tax Cuts and Jobs Act created back in end of 2017 that we call the retail glitch. That was corrected with the CARES Act. So what did that correction result in? So that provides us with some opportunities. What are the things that we can and should be doing? Important notes, again, are some of those foot faults that we want to make sure that we're just paying attention to. And then lastly, want to talk a little bit about when we have tenant improvements, what is the taxability and the treatment of that for the various parties? And I want to give you a few examples just so you have that kind of basic knowledge. So I thought it'd be important to kind of start with the history of what qualified improvement property is. So when we talk about non-residential real property, it's important to note that the IRS has specific mandated lives and methods that have to be used for depreciation. And we talk about non-residential real property. This is probably the least advantageous life and method combination that you'll see. It's generally 39 years on a straight line basis. So no acceleration whatsoever and a very long life. So in order to kind of encourage some economic development and provide some relief from that, way back in 2004, the American Jobs Creation Act kind of carved out a shortened recovery period for certain improvements. Now, these improvements had to be made pursuant to a lease, and the lease had to be between unrelated people, had to be for structural components of non-residential real property. In other words, what we would call a building asset versus personal property. And it couldn't be part of a common area. Now, I want to make sure I touch on what a common area is, because this is a question that comes up. So the benefit here is a common area is defined as costs in a building that would benefit different lessees. So when you have a situation where you have a single tenant building and you have a lobby or what we would think of as a common area, but there's only one tenant in that building. For example, our building here, we own and occupy the entire building. There is no common area under the definition. So that's an important distinction. So there is some benefit if you are a single tenant building. The costs have to be for the interior of the building that's occupied by the lessee or a sublessee. And one of the important distinctions here was the improvements had to be placed in service more than 3 years after the original placed in service date of the building itself. There were a couple of carve-outs that were important, and one is the cost can't be related to enlarging the building. The cost can't be for an elevator or escalator, and they can't be for the internal structural framework of the building, you know, the pillars holding up the roof or the floor above, things like that. So this little carve-out allowed us to have what we call qualified leasehold improvements. Qualified leasehold improvements were 15-year property, straight line depreciation in the beginning. And this was set to expire in 2006, but it kept getting extended, and bonus depreciation eligibility was eventually added. One of the things that was really important that a lot of people didn't pay attention to, so we're going back again even as early as 2004, is that the definition of qualified leasehold improvements was not elective. That is, if you had property that was qualified leasehold improvement property, you couldn't just say, oh, well, I'm going to not elect 15 years. I'm going to use the 39 years instead. And when you had that situation, if the IRS saw that you did not treat it as 15-year property, they could interpret that as if you made an election to use what we call the alternative depreciation system. And many of you are going, what the heck is the alternative depreciation system? Most people are aware that we have depreciation under what we call the Modified Accelerated Cost Recovery System, or MACRS. That is what we call the general depreciation system. That's what most taxpayers use. There is an alternative depreciation system that is elective or is required in certain cases. So anytime you have an asset, it's got some of these defined lives and methods. There is both a general depreciation, which is MACRS, and an alternative depreciation that's prescribed. The reason that's important is the ADS life is 40 years back at this time. And so it could be construed as if not only did you elect to treat qualified leasehold improvements as 40-year straight line property, but you make it based on your class life. So that would mean that you may be interpreted as having elected for all 15-year property to be using the alternative depreciation system. So that would include land improvements as well, things like site work, sidewalks, landscaping, curb and gutter, just a whole host of other costs that could get pulled into this. So it's important that we focus on this was not elective. So now this is getting extended, and we're going to get to what we call the Protecting Americans from Tax Hikes Act, or the PATH Act of 2015. Now I'm going to give you a little bit of an aside here because I'm not going to get into some of these details, but along the way, there were a few different flavors of these qualified improvements that were identified. There were qualified leasehold improvements, there were qualified restaurant improvements, and qualified retail improvements. Very similar definitions with just some slight tweaks, but we ended up with like 3 sets of very similar rules. So just keep that in the back of your mind too. So the PATH Act takes all of these qualified leasehold improvement rules, also makes it permanent, so we're not having to extend this over and over, and introduces the idea of qualified improvement property. So what is qualified improvement property? Basically, it's the same thing as qualified leasehold improvements, but it qualifies for bonus depreciation. We no longer have to have the improvements pursuant to a lease between a landlord and a tenant, and it eliminates that 3-year waiting period on placing property in service. So as long as it's sometime after the building was placed in service, it doesn't have to be 3 years after. So that's important. So then we're moving along to today. And what is qualified improvement property today? So this is the current definition. So qualified improvement property is an improvement made by a taxpayer, and that made by a taxpayer was actually added in the CARES Act. And that's important when we get to transferring property from one taxpayer to another. So the reason that those words are in there is that if I have qualified improvement property and I sell it to Ruth, while that's QIP for me, it's just non-residential real property for Ruth. So she loses that 15-year benefit. But again, it's for improvements in the interior portion of an existing building, has to be non-residential real property. So apartment buildings, residential real property are excluded, as is personal property. And again, it just has to be placed in service sometime after the building was placed in service by any taxpayer. So things that we think of when we talk about qualified improvement property. Think about drywall, think about ceilings, interior doors, fire protection systems, mechanicals, HVAC, electrical, plumbing. Again, the things that are excluded, the internal structure, framework of the building, enlargements to the building, elevators and escalators. So when we have tenant improvements, it's really important that we are paying attention, because all of these things can have both QIP and non-QIP costs. So if you think about a retail shopping center and you're putting in an HVAC system, well, that HVAC system has ductwork that's within the interior portion of that building. That would be QIP property, right? Qualified improvement property. But it also has the units up on the roof, which are not in the interior portion of an existing building, and that would not be QIP. So you're getting into some of those differentiations. Likewise, you may have certain storefronts in a retail environment where a portion of the cost is QIP and a portion of the cost is not. So I'm going to bring us up to 2017, the end of 2017. And the Tax Cuts and Jobs Act, one of their goals was to combine. We got all of these rules, they're all very similar. We've got qualified leasehold improvements, qualified improvement property, qualified restaurant improvements, qualified retail improvements. We just want one category called qualified leasehold improvements, the definition I just gave you. And so the intent of the Tax Cuts and Jobs Act in simplifying everything was, we just want qualified improvement property. We want it to be 15-year property. We want it to be eligible for bonus depreciation, which is 100% through 2022. And we want this to be an incentive that's attractive to retail and restaurant and hospitality. But they made one big mistake, and that is in drafting the Tax Cuts and Jobs Act, they eliminated language in one section of the tax code, 168K, that made qualified leasehold improvements eligible for bonus depreciation. But they forgot to change a few sections earlier in 168E to add qualified improvement property to 15-year property. So what actually happened? So the Tax Cuts and Jobs Act didn't define QIP as 15-year property. So now QIP is defined, but it remains 39-year property that is not eligible for bonus depreciation. So a lot of people are going, great, I've got QIP and I've got to now depreciate this on a straight line basis over 39 years like any other non-residential real property. Now, one important carve out that I will mention is that beginning in 2010, qualified improvement property was added to the list of property that can be eligible for some limited Section 179 expensing. And that is where you can elect to directly expense certain improvements based on caps on the amount that you can write off in a given year and the amount of improvements that can be available for that. So some of your smaller taxpayers may still have been able to get some write-off relief using Section 179, but some of your larger entities likely were not able to take advantage of that, and then they're stuck with 39-year property. Now, this was a known glitch, something that was out there for a while, and there was a lot of discussion like, hey, this has to get fixed. How does this get fixed? Well, the only fix that was available under law was new legislation. And we all know, I can't see or hear you, but I can probably imagine all of your heads nodding if we think, is Congress dysfunctional? We're probably all doing this. So it took them a while to finally getting around to going, we made a mistake. We knew it was a mistake at the time. And here we are 2 years later, we finally get around to fixing it. So the CARES Act comes around. The CARES Act was passed just in 2020. And this now retroactively corrects that drafting error. So now that qualified improvement property that was placed in service in 2018 and after is defined as 15-year property. And that means it is now eligible for that 100% bonus depreciation. It also changed that alternative depreciation system life from 40 years to 20 years for this property. Sounds great, it's all fixed. What do we need to do? So the key thing, if you remember nothing out of today's presentation that I want to make sure you're paying attention to, it's this. So key point, if you filed 2018 or 2019 tax returns with qualified improvement property shown as 39-year property, that tax return is now wrong, and you must do something about it. The reason that you have to do something about it is at the end of the day, when you go to dispose of property and you're determining your basis in the property that you're disposing, you take your original cost and you reduce it by depreciation allowed or allowable. So the fact that you only took 39-year depreciation when it was eligible for 15 years means you didn't take all of the depreciation that you were entitled to. The IRS doesn't care. They reduce your basis and you never got the benefit of that depreciation. So you must do something about it to correct that. So this again creates opportunities for us. So what are things that we should be looking for? Now is the time to go back and look through your fixed asset listings. You've got non-residential real property. Do we have any improvements to these buildings in 2018 or 19 that is qualified improvement property? Now you might have small projects and you might stop there, but if you have a very large project, you might even want to consider going back and having some type of cost segregation study. Now a cost segregation study is where you get experts like engineers, to be looking at the different systems in your building and attributing costs to those different systems. The reason for a cost segregation study is that you're able to take different aspects of your property that might otherwise be just deemed, say, 39-year property, and say that this piece, this component is actually attributable to this system. So for example, if we look at an electrical system, you know, one of the examples, and I'm not an expert on cost segregation, but one of the examples that's always stuck with me is if I've got an office building and I've got on my wall here, I've got an outlet. It's orange, it's made for the computer, it's grounded, it's so that we've got all the protections on our technology in our offices. That outlet, it's electrical, normally it's part of our non-residential real property, 39-year property. We could elect with a cost segregation study to attribute some of the costs of the electrical system for powering the computer that I'm talking to you through right now as part of the cost of this personal property. Well, likewise, you can do that same kind of thing with all of the systems that would qualify for qualified improvement property. So if you've got a large project, it might be worth taking a look at, hey, should we invest in a cost segregation study? Maybe we can pull more 39-year property into 15-year QIP, which means, again, we can elect bonus depreciation, and then we can expense it all. So now we're sitting here, if I've got 2018 tax returns. So I'm going to start with 2018. If I had qualified improvement property on a 2018 tax return that we reported as 39-year property, what do I do? Well, you really have two different options that are in front of you. The first is you can amend your 2018 return. Now, there are some really good benefits to doing this. Not only do you now go back and claim that it's a 15-year property and maybe claim bonus depreciation, but you might create what we call a net operating loss. And under the CARES Act, we can carry that back 5 years. So if I'll use the example of what we call a C corporation, or a corporation that most of us think of as like, larger corporations generally, but not one that's a flow-through or pass-through entity. C corporations under the Tax Cuts and Jobs Act had a flat tax rate established of 21%. So starting in 2018, 21% tax rate. So we now amend our 2018 tax return, create a loss in a 21% tax year, and carry that back to a year where we were in a 35% bracket. So we have some rate arbitrage available to us of 14%. Similarly, with individuals, there's some tax rate differential, but it's maybe 5%, but there are some opportunities here to tax plan to maybe get some immediate tax benefits and some cash to the taxpayer based on amending the return. Now, there are times where amending tax returns is difficult, and you may not want to amend a tax return. So the other option that you have is to file a Form 3115. 3115 is an application for a change in accounting method. So you can file that with your 2019 return and say, we want to change our accounting method for accounting for the QIPs to conform with the new rules, and we're going to claim all of the missed depreciation as what we call a favorable Section 481A adjustment. In other words, I took 1/39th of the depreciation in 2018. I now want to catch that up as if I had taken 100% bonus depreciation, and I'm going to take the rest of that write-off in my 2019 return. So that's an option for you if you don't want to amend 2018. Now, what about 2019? So if you haven't filed your return yet, so your return might be on extension depending on what type of return. It might be due in 6 days. It might be due in a month and 6 days. If you haven't filed your return yet, make sure you're treating your qualified improvement property as bonus eligible 15-year property. But what if I filed my return already? Well, there are two different options for you. If you initially extended your tax return, but have already filed it, you still have through the extended due date to file what we call a superseding tax return. That is, if my corporate tax return's on extension, it would have been due October 15th as the last day of the extension, but I filed it back in July. I can go, you know what, do over. I still have till the extended due date. Forget the return I gave you. Here's a superseding return with the right QIP presentation. And then likewise, you could amend your 2019 tax returns to claim the QIP as 15-year bonus eligible property. So I mentioned earlier, there are often a number of foot faults and things that can trip us up. So I want to just point out a couple of those to you here, just so you're considering these as you're thinking through if you've got a situation that you're working with or somebody you're working with that has this, what are the things they should be thinking about? Bonus depreciation. So the general rules for bonus depreciation, again, these are general rules, are that the original use of the property must start with the taxpayer. So if I'm the one who's paying for the qualified improvement property, this is brand new property. Nobody's ever owned it before. I was the first person to use these improvements. It could also be used property if it meets certain requirements. And those requirements are generally I'm not buying it from a related party. So it's not from a member of my family. It's not from a corporation I own more than half of. It's not between two partnerships that have more than 50% common control, or members of a corporate controlled group. So unrelated parties. Those are the general rules. If you meet those, it generally qualifies for bonus depreciation. Again, we talked about cost segregation studies. So if you want to take an aggressive position, if you have a large project and you want to go, I want to pull as much property into 15 years as I can, especially if I'm looking to try and jam an NOL into 2018 that I can carry back and benefit from that interest rate or tax rate arbitrage, excuse me. A lot of times it's important that you have a cost segregation study. Now, we do not at SVA do those. We have a company that we work with that we outsource that to, and they have all of the engineers on staff. We are just accountants at our firm, and we don't have the engineers here to do that justice, but they do cost segregation studies for these larger projects. Why is that important? Because it is an area that can be under increased scrutiny. So if the IRS is ever taking a look at something under audit, you want to have that cost segregation study to support the position that you're taking. Number 3 is a big one. So the Tax Cuts and Jobs Act did many things. Most people think of it as it cut taxes for most Americans. It established a flat tax rate of 21% for corporations. But one of the things that it also did was it put a limit on the deductibility of interest. And in particular, the general rule was interest deductions were limited to 30% of adjusted taxable income. That later got increased to 50% for non-partnerships, but general rule 30%. So when you had a rental property or a entity that had as its only activity rental property, everybody knows that a lot of times rental properties are set up because of depreciation. They generate losses but positive cash flow. And so with these limitations in place, it was possible that you would not have any adjusted taxable income. So 30% of a zero or a negative number is we can deduct no interest. And so for a number of our clients, for a number of entities, we go through and we evaluate. Okay, there is an election that the TCJA allows, which is called the Real Property Trade or Business Election. So we can make this election and say, we want to be treated as a real property trade or business. We will, in order to get out of the interest limitation, agree that we will depreciate our real property using the alternative depreciation system. Now, the TCJA shortened the lives of those alternative depreciation system assets that qualify as real property. So non-residential rental is still 40 years, but residential went from 40 years to 30 years. So the difference between 39 and 40 is 1 year. Residential was 27.5 to 30 versus 27.5 to 40. So we do the calculations and we go, are we better off taking the depreciation deduction and limiting interest, or are we better off deducting interest and pushing out our depreciation over a longer period? And if we make this election, it was an irrevocable election. So a lot of entities said, you know what, I'm better off if I deduct the interest and take my depreciation over an extra year. Well, the other piece that was included in that decision making was, at the time, qualified improvement property was 39-year property. So 39 to 40 years, no big deal. Well, if we now look at the new rules, if we've made that election, then qualified improvement property has to use the alternative depreciation system. It's 20 years instead of 15, straight line, but we can't claim bonus depreciation. So if we have a lot of QIP, we're going, wait, I could have written this all off with 100% bonus depreciation, and instead I'm stuck in 20-year straight line. Well, that changes my calculus maybe, and I wouldn't have made that election. Well, with the new rules, you can revoke that election, and then you can, if necessary, make it again in a later year. So there's a revenue procedure 2020-22, that provides for the revocation of this 163J real property trade or business election. Now, it's important to note that if you are going to revoke the election, it has to be done by October 15th, 2021. And it can be done either on an amended tax return, or you can file what we call an administrative adjustment request, which would be a prospective adjustment. So I wanted to make sure I brought that to your attention, because in the you need to do something department, this is another thing you need to consider, because we're down to about a year if you want to revoke this election. Couple of other important notes. Beginning in 2018, the IRS implemented what's called the centralized partnership audit regime for certain partnerships. And the partnerships that are subject to this, those that can't elect out, it depends on the number and type of partners in the partnership. But a lot of partnerships are now subject to this new partnership audit regime. The IRS got tired of trying to track down if we make an adjustment in the partnership and it flows out to all these tiered partnerships, etc. Do we really want to deal with all of the audit issues, or we want to just charge the tax at the partnership? And then there are certain rules about if they're allowed to push those adjustments out. But one of the consequences of this change is it really limits what can be done when you want to make a change in a partnership environment. So partnerships were now no longer allowed to just amend prior tax returns. Rather, they have to make what we call that administrative adjustment request. So why is that important? So instead of being able to go back to 2018 and amend the tax return, we make an administrative adjustment request in September of 2020. So that adjustment doesn't impact the 2018 return. That adjustment shows up in the 2020 return. And that's important because it impacts all of the things we talked about with lost carrybacks and just the treatment of those losses and the timing. When it comes to deductions in taxes, that is a hugely contributing factor to the benefit. Timing of deductions is very important in determining the benefit of those deductions. In other words, present values, or the time value of money comes into play. $1 of deduction in 2018 is worth more to me than $1 of deduction in 2020, because I can get money back. Likewise, future benefits aren't as valuable as present benefits. And then lastly, state tax laws often don't conform to bonus depreciation. So you got to make sure you're paying attention to how all of this is going to impact your state tax returns. So I use the example in Wisconsin, since we're in Wisconsin. So QIP is still subject to a 39-year tax life. So this is a federal tax issue, not a state tax issue. Again, if you're looking for how can I get some state tax benefits, in other words, how could I possibly pull real property into personal property, my example from before, if you've got a large enough project where it makes sense from a cost-benefit standpoint, cost segregation may provide you with some benefit. Oops. So before I move on to tax treatment of tenant improvements, I want to reiterate kind of the main point that I hope you all take away today, which is if you have qualified improvement property from 2018 or 2019, and you treated it as non-residential real property and took 39-year straight line depreciation on those assets, you have to do something. And so we covered, what your options are today, but I wanted to make sure if you take away nothing else, just know I have to go back and look. I might need to do something. I should probably call my tax advisor and go through this with them and see if I need to amend some of my tax returns. And in doing so, what are the ways that I can go about adjusting for this and getting the biggest tax benefit that I can? Now, the last thing I wanted to cover with everyone today is tax treatment of certain tenant improvements. So this is a question that I get quite often. I work a lot with real estate, obviously, and real estate associated nonprofits. A lot of lease questions come up. I do a lot of mixed use and residential properties where the city is requiring a certain amount of commercial space. Maybe you have master leases and you've got all of these rules about tenant improvements, and we're providing allowances and things like that, and who's paying for the improvements. So a couple of the big questions that always come up is who should make the improvements, the landlord or the tenant? Who actually owns the improvements? Again, the landlord or the tenant. And then how are those improvements paid for? And depending on each of those situations, it can have different tax consequences for the different parties. So I wanted to share 4 examples to kind of illustrate the implications of how you answer these questions. So I want to start with what I call the simplest form. And that is, if I am the landlord and I lease property to Ruth and Ruth is the tenant, if I do the build out, I pay for it and I own those improvements, that is simple. The tenant has no tax consequences. For me, I have constructed an asset, and it might be qualified improvement property that I could write off as 100% bonus depreciation. I get the benefit of depreciation deductions or possibly a Section 179 deduction where I might be able to get some even immediate write-off. And then I might have a capital loss on disposition of assets at the end of the lease. So if they were constructed specifically for Ruth in this example, and at the end of the lease, I haven't depreciated them fully, I might be able to write off the rest of those at the end of the lease. So this is typically good when I have, as a landlord, improvements that I'm going to make that are likely to benefit not only the current tenant, Ruth, but maybe Jane or a future tenant. And so I might want to have the control of those assets, and I can probably take a benefit for that over a longer period. Things to watch out for is that if I create a large amount of bonus depreciation or write-off, I have to look at my, as the landlord, tax situation. Does this cause a problem for me? Because there are limitations on losses in rental real estate. So do I have a situation where I create a loss that's not currently deductible for me, and now maybe I'm not getting the benefit out of it that I thought I would? But again, this is probably the simplest and easiest situation. Gets a little bit more complicated if we say that I construct and own the improvements, but I'm reimbursed by the tenant, and maybe that's a substitution for rent, or even if the tenant makes and pays for the improvements as a substitution for rent. So now again, I as the landlord own the asset, so I have the asset, it might be QIP, and I might be able to benefit from depreciation, including potentially bonus depreciation, maybe Section 179. But what happens to that reimbursement payment or the monies that the tenant paid out for those improvements? Whoa, wait a minute. I have to recognize that as rental income when I receive it. So that means when those improvements are paid for, I have receipt of all of that rental income up front, and I have to recognize that as income. Now the tenant paid for all of these improvements. What are they doing with that? They get a deduction. They get to amortize that reimbursement as rent over the lease term. So they have to write it off over their lease term. If they have a 10-year lease, they take 1/10 each year. And then again, at the end of the lease, if those assets were specific to that tenant, I can write them off at the end of the lease. And the tenant, if they get out of the lease early, say, and they have some unamortized rent reimbursement or the cost of those upfront assets, they can write that off at the end of the lease. So again, this may not be favorable to the landlord because I'm having to pick up income for this rent substitution all up front. And I will tell you that within the last few years, I have had some clients who didn't talk to me first, went and structured leases with third parties, and didn't realize what they were doing, and I had to be the one to tell them that they had to pick up $300,000 of income all in the first year. So it's one of those things where you want to make sure you're paying attention to what the terms of the lease are. So what happens if the tenant makes and owns all the improvements? They don't get any money from the landlord, so there's no substitution for rent. Again, this is another simple form, and this is probably best when the improvements are tenant specific. So in this case, as the landlord, I don't own the asset, I don't have an asset, I don't have any income or deduction, I don't have anything I have to deal with, so real easy for me. For the tenant, they've constructed an asset, possibly qualified improvement property, so they can then write that off through depreciation, possibly qualify for bonus depreciation or Section 179 to get an immediate write-off. And then again, anything that's undepreciated at the end of their lease when they terminate, or that's left behind at that point, they can write off at the end of their lease. So again, another simple variation. And then lastly, if the landlord provides a cash allowance to the tenant, and then the tenant makes and owns their improvements. So what do I have as the landlord? Well, I've provided what we call a lease incentive. So that lease acquisition cost, I get to deduct over the lease life. And there's some special rules I'm not going to get into. I'll send a copy of my presentation to Ruth after we're finished here today. But for short-term retail leases, there are some special rules where I may end up with some non-residential real estate treatment, especially if those revert to me at the end of the lease. But generally, my cost for that cash allowance, even though I pay it all up front, I have to write it off over the lease term. And the tenant has an asset that they constructed, could be QIP if it was used for an asset. Again, they get to depreciate that potentially with bonus depreciation or Section 179, and would get a write-off at the end of the lease for the assets that were left behind. But that allowance for the tenant is income immediately. And this is another situation that I've seen where a lease didn't meet the Section 110 exclusion for a short-term retail lease. And I had to explain to one of our clients that the lease they wrote with their tenant just created a certain amount of taxable income for the tenant that they had to tell the tenant that unfortunately they had to pick up as income this year. So again, if you have these types of situations and you're dealing with tenant improvements, I would just say make sure that you're looking over what the terms are and what the tax implications are, because depending on how you structure it, it could cause an unintended consequence to either the landlord or the tenant. And especially depending on which side of that you're on, you might have an incentive to go in one way or another. So that's the bulk of what I had to discuss today. That's the end of my prepared remarks. I don't know if any questions have come through, Ruth. Hopefully everyone's still awake. I know qualified improvement property at 8 a.m. is always exciting on a rainy day. I know it's how I wake up every morning. I have my alarm set to it. Mm-hmm. I'm kidding.
Yeah, Alexa is set for that. Yeah, she just starts the day with presentations about it. We actually haven't had any questions pop up yet. Oh, Richard has raised his hand. All right, let's see if we want to add him. All right, Richard, so you're able to talk?
What are the conditions for creating a short-term lease under Section 110 versus long-term leases in your example 4, please?
So Section 110 short-term leases, generally 15 years or less. It's got to be in a retail space environment. So if it's 15 years or less for retail space, then that could qualify for this exclusion. And the reason the exclusion is important is because then you don't have income recognition for the tenant to the extent the allowance is used to construct improvements, because the improvements have to revert to the landlord at the end of the lease. So those are the two qualifications: retail space, 15 years or less, and the improvements revert to the landlord at the end of the lease. And in that case, for depreciation purposes, the landlord treats the improvements as non-residential real property, and they would get some depreciation benefit. So in my example, the reason it was a problem was because the tenant didn't use the allowance for improvements. And I'm like, that was a mistake on their part.
For clarification, is it strictly retail, doesn't apply to any office or any of the other categories?
I would have to double check on that. I know the definition off the top of my head is it's retail space. So I'm not sure if it would apply to office or not, but I can double check on that and get back to you through Ruth if you'd like when I send the presentation over.
Thank you.
All right, is that it for you, Richard? I still don't see any other questions. Anyone else interested in raising their hand?
I have another question.
Oh, sure.
So do you have to do the cost segregation to go back and to get some of the bonus depreciations from years 2018 and those kind of things?
Absolutely not. I probably gave it more weight than I should in my presentation. The only time I would do a cost segregation study is if I have a large project with a lot of QIP where I thought, hey, I can get even some more big dollars into 15-year property. So for a lot of the projects that I work with on a day-to-day basis, it doesn't make economic sense because you have to pay for a cost segregation study. So the time value, because really you're just playing with the timing of deductions, right? The cost of the property is the cost of the property, whether I write it off over 15 years or 39, I'm getting the same nominal value of deductions. So the time value of the deductions has to outweigh the cost of the cost segregation study. So that's why we typically don't see them on smaller projects. So it's absolutely not necessary. And if you have qualified improvement property in 18 or 19, you should be doing something about it. You don't have to get a cost segregation study or incur any more costs, other than you may need to amend your return or take some of the other actions we talked about.
All right. Unless Richard has another question, I don't see any questions in the Q&A or in the chat. So I just want to say a big thank you to Douglas for being here today. Obviously a very complicated but important issue for our commercial agents. And so thank you so much for giving us your time today, Douglas. And thank you to the Commercial Services Committee for helping us to put this event on.
Absolutely. I want to thank you all again as well. My contact information's on the screen. If you don't have a pen to jot my phone number or email address down, Ruth knows how to get a hold of me. If you have questions, definitely reach out to us. Be happy to talk with you about your specific situation or a client need. Maybe we have a mutual customer that we can help. So
wonderful. Thank you so much. Everyone have a wonderful day.